Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked. I'm David Robson, and today we're decoding the tax side of subscription businesses. Whether you sell SaaS, curated boxes, memberships, or a hybrid of all three, this episode gives you the playbook to minimize tax without blocking growth. We'll cover revenue recognition, sales and use tax, nexus across states and borders, entity strategy, cash flow timing, and the systems that keep everything clean. My promise, practical steps, a dash of humor, and zero jargon you can't use on Monday. If taxes make subscriptions feel like a leaky bucket, let's plug the holes and keep more cash where it belongs, funding your roadmap, not surprises. Grab a notebook, your billing dashboard, and maybe coffee. We're about to make compliance profitable for you. First, revenue basics. Cash accounting records income when money hits your bank. Accrual recognizes revenue as you deliver service, matching revenue to periods and expenses. Subscriptions span time, so accrual usually wins for clarity, investor credibility, and compliance. Taxable income is generally triggered when the right to payment is fixed and the amount is determinable, even if customers haven't paid yet. Cash can overstate profit in month one and understate it later. Accrual smooths results and highlights churn. If you're small and on cash now, consider whether growth, financing, or multi-year deals make accrual and a formal close worth the upgrade. Bonus: accrual makes it easier to reconcile deferred revenue, track cohorts, and defend your numbers in an audit. Your future self will absolutely thank you later. Advance payments are common: annual prepay, lifetime deals, gift subscriptions, and credits. Financially, you record deferred revenue and recognize over the service period. For tax, Section 451C and Reverence Proc 2434 let eligible taxpayers include advance payments in income either fully now or partly next year, deferring the portion earned after year end. You must mirror your financial statements and track deferrals consistently. Gift subscriptions create revenue when redeemed or when breakage becomes remote. Document policies. For breakage, follow your redemption data and apply a rational, consistently applied estimate. Pro tip: align contract language and billing settings to support deferral. Use separate liability accounts by product line and reconcile monthly so tax deferrals match revenue schedules and gateway settlements. Auditors love tidy, repeatable processes. Banks too. ASC 606 wants you to recognize revenue as performance obligations are satisfied. Tax follows similar timing but can diverge without planning. Keep tax and books aligned by mapping products to obligations, access to software, support, onboarding, and physical items. For multi-year contracts with annual billing, recognize ratably unless distinct elements warrant allocation. Upgrades and downgrades are contract modifications. Document the new consideration and update schedules, not just the invoice. Renewals with material changes are new contracts. Auto-renewals usually aren't. Use your billing system to time proration entries and export schedules into your GL. Consistency reduces audit exposure and underpayment penalties. Create a simple checklist for sales ops. Identify obligations, term, refund rights, and price changes before contracts are signed, not after revenue posts. Less cleanup later. Discounts and promos reduce the transaction price. Record them contra revenue, not as marketing. Free trials with no payment info create no revenue. Trials that require a card need clear start dates to avoid premature recognition. Refunds and credits should reverse revenue and any associated sales tax collections. Keep a tight approval trail. Chargebacks? Treat as refunds plus potential fees. Proration requires careful schedule updates when customers change plans mid-cycle. For bad debts, accrual taxpayers can deduct amounts previously included in income when deemed partially or wholly worthless. Document collection efforts. Cash basis taxpayers generally don't need a bad debt deduction for unpaid invoices. If you use third-party processors, reconcile fees and chargeback timings monthly, so revenue, receivables, and processor statements all tie to the general ledger. No surprises. Bundles and subscription formats drive sales and tax complexity. Start with the true object. Is value in digital access, tangible goods, or services? Many states tax tangible items and some services, while digital and SaaS vary widely. Break out invoice line items with defensible fair values. Hiding taxable goods inside membership invites trouble. For boxes, tax the product at the destination rate, separately state shipping and handling where it helps. Maintain resale certificates for inventory and exemption certificates for qualified customers. Selling through marketplaces? Facilitator rules may shift sales tax collection to the platform, but inventory there can create nexus. Clear SKU mapping and tax codes in your engine prevent both over and under collection. Test sample orders regularly to confirm build rates, match current statutes. No guessing. SaaS and digital services face a patchwork of sales tax rules. Some states tax SaaS broadly, e.g., New York, Massachusetts, Washington. Others exempt it, and many tax-related services like remote support or data processing. Configuration matters. Your billing system must carry destination address, product tax codes, and customer exemptions to the tax engine at invoice time. Avoid tax-included pricing unless your engine supports it. Watch marketplace facilitator rules if you sell through app stores or platforms. Review taxability often. Legislative updates move fast. A quarterly nexus and taxability checkup prevents ugly assessments and angry customers later. Document positions with citations and screenshots, and store rate matrices. If a state disagrees, you can demonstrate good faith compliance and negotiate penalties down. Paper trails persuade, often. Nexus isn't just sales volume. Remote employees, contractors, inventory and 3PLs, trade shows, or installing equipment can create physical nexus for sales and income taxes. Economic nexus thresholds, often $100,000 or 200 transactions, still apply in many states for sales tax. For income tax, most states use market-based sourcing for services, assigning revenue to where customers receive the benefit, usually your customer's billing or use location. PL 86272 protects sellers of tangible goods, not SaaS or services. Keep a nexus tracker by state, noting trigger dates, thresholds, and filing status. Register proactively. Late discovery means penalties and no sympathy. Budget for minimum taxes in tough states, and align your tax calendar to higher dates and inventory movements to avoid unpleasant quarterly estimate surprises. Plan cushions. Always. Serving customers abroad? Digital VAT and GST regimes may require you to register and collect tax based on customer location even without a local entity. The EU, UK, Canada, Australia, and many others have thresholds and simplified registration portals. If you sell through app stores or platforms acting as merchant of record, they may collect, verify contract terms, and keep platform invoices for your records. Configure IP, billing address, and bank bin checks to determine location. Use certified providers or OSS, IOSS where available. File on time. Penalties accumulate quickly. Start with your top countries by revenue and expand coverage deliberately. Expect differing rules for B2B versus B2C, invoice requirements, and credits. Consistency and evidence beats guesswork when tax authorities ask how you source transactions. Be ready. Accounting method drives timing. Small businesses may use cash, simplified inventory, and unicap relief, but subscriptions often benefit from accrual for cleaner deferrals. Consider an automatic Form 3115 change if your books and tax diverge. Pair method choice with CAC policy. Under GAAP, ASC 34040 can require capitalizing incremental commissions and amortizing over expected customer life. Tax often allows faster deductions for advertising and many partner payouts. Track affiliates, reseller margins, and app store fees in distinct accounts to drive 1099s and taxability. Tie attribution systems to the ledger so CAC by channel reconciles. Before big campaigns, model tax and cash so expense timing doesn't distort margins. If capitalization applies, document amortization periods, churn assumptions, and impairment triggers to satisfy auditors and defend positions during examinations. Software development has tax landmines and opportunities. Section 174 requires capitalizing and amortizing R&D over 5 years, 15 if foreign, mid-year convention, plan quarterly estimates accordingly, offset the pain with the federal credit and state credits. Qualified startups may apply the federal credit against payroll tax, track projects, time, and contractor scope contemporaneously, separate maintenance from new features. Now, entity strategy. LLCs taxed as pass-throughs may get the Section 1999A deduction and face self-employment tax. S corporations can reduce SE tax with reasonable compensation. C corporations may unlock Section 12102 if eligible. Model multi-year tax and fundraising realities and revisit after material scale events. document compensation studies, board minutes, and equity plans. Blurry documentation sinks benefits faster than any spreadsheet can save them during an exam. Paying people and platforms creates reporting traps. Collect W-9s before first payment, issue 1099 NECs for eligible contractors, and apply backup withholding when required. Reconcile 1099-Ks from processors to your ledger and bank, investigate timing differences and chargebacks, build a chart of accounts for deferred revenue, sales tax payable by jurisdiction, and processor fees. Use a tax engine, reconcile gateways monthly, and store exemption certificates centrally. Calendar estimates around renewal spikes so cash covers quarterly taxes. Common audit triggers: uncollected sales tax, inconsistent revenue timing, nexus gaps, and weak refund documentation. Quick wins: a SaaS client deferred annual prepay under 451C, a box seller fixed shipping tax. That's today's playbook. Smart systems, clean documentation, and a proactive advisor keep growth tax efficient. I'm David Robson. Thanks for listening.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.